Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. Today's episode is going to be on flexible spending accounts and healthcare savings accounts. I realized that maybe this episode would have been more helpful a few months ago before the normal open enrollment period for people, but the idea didn't come to me soon enough to get it done by then. And since in a previous episode of this podcast, I did say I would make an episode all about flexible spending accounts and healthcare savings accounts, I didn't want to wait to do this topic until months from now. Flexible spending accounts, abbreviated FSA, and healthcare savings accounts, abbreviated HSA, are both tax-advantaged savings accounts designed to help people save and pay for medical expenses. Anytime you use pre-tax money to pay for things, the better. Because basically, you're getting a 22 to 37% discount depending on your tax bracket. However, there are some very important differences between these two types of accounts, and you don't want to get these two accounts confused. Let's start with discussing the flexible spending account, which is probably the simpler of the two. An FSA is a benefit that may be offered by your employer, though your employer may not cover the fee for the FSA. With the FSA, you let your employer know how much you want deducted from your paycheck to go into your FSA. This occurs when you're starting your job and filling out all the paperwork for your benefits, and it can also happen during open enrollment. If you are starting the job, you will fill out the form with how much you want contributed from your paycheck for the current calendar year. If it's during open enrollment, which usually happens around October or November, then you'll fill out the form on how much you want contributed for the following year. You can contribute any amount up to a maximum of $3,300 for a single person and $5,000 for your household if you have dependents for 2025 per the IRS. Employers can choose to limit employee contributions to less than the IRS limits. Employers can also contribute to their employees' FSA, but the total combined contribution can't exceed the IRS limit. How much you want to contribute will depend on how much you typically spend annually for medical expenses. If the copays for your medications cost you $100 a month, then you'll want to put at least $1,200 into your FSA. Add in the copays for your typical annual medical appointments, and that may be another few $100s. If you wear contact lenses, add in that cost too. If you're covering your family, add in their medical expenses. You want to be somewhat accurate in estimating your medical expenses to prevent losing money. The big downside of FSAs is that money in it is use it or lose it. Your employer can offer one of two options if you have leftover money at the end of the year. They can allow you 2.5 more months to spend the leftover money, essentially extending the time to mid-March, or they can allow you to carry over up to $660 in 2025 for you to spend in 2026. If you leave your employer, you cannot take the funds left in your FSA with you. If you're single and put the max contribution of $3,300 for 2025, but only end up spending $1,000 on qualified medical expenses, then you would lose $2,300 minus the $660 that rolls over for a total loss of $1,640. Even if you're in the 37% tax bracket, you've only essentially saved $370 of the $1,000 in medical expenses, which is much less than the $1,640 you lost. This is why it's so important to actually calculate out what your expected medical expenses are going to be and only put that much money into your FSA. Not everyone will benefit from having an FSA. If you are someone who doesn't typically have a lot of medical expenses, like my husband, it may not be worthwhile to have an FSA. My husband takes no medications. His insurance has no copay for preventative medical appointments like his annual exam, and he really gets sick enough to see a doctor. He's never even had a single cavity. There are many years where his qualified medical expenses are zero. His employer charges around $7 a month for him to have an FSA, so it doesn't even make sense for him to put in the amount that would carry over each year just to use in case he does have some medical expenses. In contrast, at my last full-time job, my employer did not have a fee for my FSA. I took medications where I typically spend $45 a month on copays. I also have to pay a copay to see some specialist, which happens 2 or 3 times a year. So it does make sense for me to have a FSA and put in at least $540 to cover my medications, $90 to cover my copays, another $660 to cover any possible additional expenses, since if I don't use it, it will roll over to the next year. This would be a total of $1,290, which is still a lot less than the $3,300 maximum for an individual. Whatever amount you decide to contribute to your FSA will be taken out in equal increments from your paychecks throughout the year. If you decide to contribute $2,600 and you get paid every 2 weeks, then $100 will come out of each paycheck over your 26 paychecks for the year. However, the full $2,600 is available for you to use on expenses incurred starting on January 1st of the year. FSA money is use it or lose it. If you leave your job in the middle of the year, whatever money is in the account stays with your employer. FSAs are tied to employment. When you think about giving notice, consider checking the balance on your FSA and finding ways to spend the money that's left in it before your last day of work. Some employers may offer a short grace period where you can submit claims for expenses incurred while you are still employed. You cannot use FSA funds for expenses incurred after your departure date unless you have COBRA coverage. If you used more of your funds from your HSA than you've contributed, and then you leave your job, you do not have to pay back the difference. This is where the use it or lose it benefits you as an employee. One little money trick you can do is if you know you're leaving your job before the end of the year and you want to get refractive surgery, you could put in the full $3,300, get refractive surgery early in the year, use up all your FSA money, and then go ahead and leave your job, and your employer will have subsidized your refractive surgery. Of course, this only works if you already know ahead of time that you'll be leaving your employer the following year, and you have something that would be a relatively large qualified medical expense, like doing refractive surgery, by which I mean LASIK or PRK. What are qualified health expenses that you can use for your money in your FSA? I've already mentioned copays for appointments and prescription drugs. Medical devices and over-the-counter drugs are also covered. Medical testing like labs and imaging are covered. Medical procedures and surgeries are covered. Dental expenses, including exams, cleaning, x-rays, fillings, braces, etc., are covered. Vision expenses, including exams, the refraction fee, contact lenses and supplies, eyeglasses, and, as I said earlier, even laser eye surgery is covered. Professional services like going to your chiropractor or getting acupuncture is also covered. Some plans may cover massages, but that is a little bit more in the gray zone. My FSA would not reimburse me for massages, although my massage therapist says that he has clients where they can use their FSA funds. Now let's switch to talking about healthcare savings accounts, or HSAs. Healthcare savings accounts are my favorite accounts for investing. It's the only account that gives you triple tax advantages. The money goes in pre-tax, it grows tax-free, and if you follow the rules, you don't have to pay taxes on withdrawal. The main issue is being eligible for a healthcare savings account or a healthcare brokerage account. To be eligible for a healthcare savings account, you must be enrolled in a high deductible health plan. High deductible health plans have lower premiums but high deductibles compared to other health insurance plans, meaning you pay a lot more out of pocket before insurance coverage kicks in. This can work for people who are overall healthy and don't make a lot of use of their healthcare insurance. It can also potentially work for people who spend a lot on healthcare each year, such that their expenses greatly exceed even a high deductible. If the cost of a lower premium plus the high deductible is similar to the cost of another insurance with a high premium plus a lower deductible, then it may not make much monetary difference to go with a high deductible plan. The math is made a little bit more complicated in that your health insurance premium is paid with pre-tax dollars, but your healthcare expenses are paid with post-tax dollars unless your medical expenses exceed 7.5% of your adjusted gross income. Then there's what portion your employer contributes to your insurance premium to consider, as well as what health insurances your employer offers. This assumes that you even get health insurance through your employer. If you have a spouse who is employed and eligible for health insurance through their employment, this gets even more complex. This isn't meant to be an episode on how to choose your health insurance, so I'll stop here with this train of thought. The real point of this discussion is that a high-deductible health plan is not the best choice for everyone, nor is it available to everyone. But if it is a good choice for you or your spouse, and you or your spouse choose to have a high-deductible health insurance plan, then you would qualify for a healthcare savings account. For those of you eligible for an HSA, in 2025, you can contribute $4,300 for individuals and $8,550 for families. If you are 55 or older, you can contribute an additional $1,000 as a catch-up contribution. I'm not sure why they have a catch-up contribution in this case, but older people do tend to have higher health care expenses, so that could be part of the logic. Unlike with the FSA, any money in your HSA will not go away or disappear if you don't use it. Essentially, it always rolls over every year. This means you can allow it to grow over time and not withdraw from it to let it keep growing tax-free, and then use it towards your medical expenses when you're in retirement or some other future date in the decades ahead. What's even better is that HSAs are individual and portable. In fact, you don't even have to use the specific HSA provider your employer chooses. As long as you have a qualified high-deductible healthcare plan, you can open your own HSA with the provider of your choice. Your HSA is yours. It's not a benefit from your employer. When you leave your job, you keep your HSA. If you did use your employer's chosen HSA provider, then you can move your HSA to a different company. Vanguard and Fidelity offer HSAs. Charles Schwab has a HSBA, or Health Savings Brokerage account, which is basically the same as an HSA account. If you haven't picked up on it yet, the biggest difference between an FSA and HSA is that with an HSA, you can invest the money to grow. A FSA allows you to save money by paying for medical expenses with pre-tax dollars, but the money goes into the account with each paycheck and sits there. It doesn't even earn interest while it's sitting there. With an HSA, you can invest in whatever investments are offered by your HSA provider. If your HSA is with Vanguard, then you have access to all of Vanguard's index funds. An HSA can be another tool to help fund your retirement. If you have a high-deductible healthcare plan so that you are eligible for an HSA, max out that HSA every year and invest it. Use other funds to pay for your medical expenses, but keep all the receipts. Let the money in the account grow year after year after year. If you invest $4,300 a year at a 7% real rate of return, you could have more than $190,000 with $86,000 in contributions after 20 years. Medical expenses tend to increase as we age, so there will be plenty of uses for the funds in that HSA later. At the point where you do want to tap into your HSA for funds, submit your medical receipts that you've saved over the years to get reimbursed by your HSA. Depending on where you have your HSA, there will be different protocols for how you can withdraw the funds from the account. Some provide debit cards or checks, which can be convenient to pay for current medical expenses. Some allow online transfer or online bill pay to pay medical providers directly. Withdrawals for qualified medical expenses are tax-free. If you are under age 65 and you use your HSA funds for non-qualified expenses, then you will pay income tax and a 20% withdrawal penalty. Once you are at age 65 or older, the 20% penalty goes away, but you'll still pay income taxes if you use the money for non-qualified expenses. But there's really no reason to pay taxes or penalty, assuming that you've had some medical expenses and you kept those receipts. If you open your HSA in 2024 and pay out of pocket for medical expenses in 2025, you can submit the reimbursement for the medical expense anytime later, whether the year is 2030 or 2040. As long as the medical expense was incurred after your HSA was open, there is no deadline for reimbursing yourself. Qualified medical expenses for HSAs are basically the same for FSAs. You can also use funds in your HSA for costs associated with helping with activities of daily living, which means that it can be used for long-term care services. I hope you can see why I love investing through an HSA. If you have access to a high deductible healthcare plan, depending on your circumstances, you may want to consider the benefits of investing through an HSA as a factor in your choice of a health insurance plan. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you found this episode useful, please share this podcast with others. The best thing you can do to support this podcast is let other people know about it. Have a wonderful week, and I'll be back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.